Imagine one day the Prime Minister steps up to the podium with an epochal announcement. The country has completely paid off its national debt. The last bond has been redeemed, the last loan repaid, the balance sheet zeroed out. It would seem to be a triumph of fiscal discipline, a celebration of economic freedom. But the next morning, bankers wake up in panic, pension funds urgently convene meetings, and the central bank realizes it has just lost its most important tool for managing the economy. Within months, an economy that seemed strong begins to wobble, financial markets lose their bearings, and investors desperately search for somewhere to safely park their money. This is not a fantasy scenario. These are the real consequences faced by countries that have approached zero debt and which leading economists analyse today. Modern economic science has reached a paradoxical conclusion. Moderate government debt is not just permissible, it is necessary for the stable functioning of a developed economy. Nobel laureate Paul Krugman explains it simply. We didn't pay off the debt from World War II. Federal debt in the Kennedy era was even slightly higher than in 1946. But as a share of GDP, it fell sharply thanks to economic growth and inflation. The real question is not how to eliminate debt completely, but how to maintain it on a sustainable trajectory relative to economic growth. When a country tries to eliminate government debt to zero, it unwittingly dismantles critical infrastructure on which the entire financial system depends. To understand why complete debt repayment creates problems, one must grasp the unique role of government bonds in the modern financial system. They function not merely as a government debt instrument, they are basic infrastructure without which financial markets cannot operate efficiently.
The global government bond market is valued at approximately $80 trillion, and this is no accident.
It services quadrillions of dollars in derivatives and enables the functioning of short-term lending markets, critically important for daily capital flows. Government bonds perform 4 irreplaceable functions. They serve as risk-free collateral in financial operations, create a pricing base for determining the value of all other assets, provide liquidity during crises, and act as a safety anchor for the entire system. When a bank issues a mortgage loan, it uses government bonds as collateral to obtain short-term financing through the repo market.
This market processes about $12 trillion daily, and nearly $9 trillion of that is secured by government bonds. Hedge funds post bonds as collateral at derivatives clearinghouses. At least 50% of the $370 billion in collateral for interest rate swap operations uses them.
If governments suddenly stop issuing bonds, this vast machinery of financial operations would grind to a halt, as no alternative possesses the necessary combination of zero credit risk, guaranteed liquidity, and regulatory recognition. The yield on government bonds creates the base curve from which everything else is priced. When a corporation issues bonds, it determines the interest rate as the yield on comparable government bonds, plus a credit risk premium, typically 50 to 300 basis points, depending on the rating. Mortgage rates, swap costs, option prices, all are calibrated relative to the government bond yield curve. The US. Treasury yield curve is published daily by the Treasury Department and covers maturities from 3 months to 30 years based on quotes from the most recent auctions. Without this curve, financial institutions lose the only reliable pricing benchmark, and markets are forced to switch to swap curves, which themselves contain credit risk and are less transparent. The liquidity of government bonds is unmatched among financial instruments. US
Treasury bonds trade daily for $515 to $570 billion, and in moments of stress, volumes reach even higher levels. In April 2025, during a tariff shock, single-day volume reached $472.5 billion.
Bid-ask spreads for the most active issues are typically measured in fractions of a basis point, meaning near-instantaneous ability to convert bonds to cash with minimal losses. Compare this to corporate bonds, where even for the largest issuers, spreads can reach 5 to 10 basis points in normal times and widen dramatically during crises. During the 2008 financial crisis, when many markets froze, yields on 3-month US Treasury bills fell to nearly zero, despite the government almost doubling issuance volume
from $1.2 to $2 trillion in 3 months.
Demand so exceeded supply that investors accepted near zero yields simply for safety. This demonstrates the safe haven function. When the financial system is under threat, investors move en masse into government bonds, stabilizing prices and providing governments with cheap financing precisely when it's needed most. For institutional investors, government bonds are not merely one option, they are a critical necessity embedded in the very structure of their business. Pension funds manage liabilities stretching 20 to 50 years into the future, promising regular payments to retirees. The only way to reliably hedge such long-term liabilities is to invest in long-term assets with predictable cash flows and zero default risk. Government bonds are the only asset class combining the necessary duration, up to 30 to 50 years, safety, and sufficient market size. In the UK, pension funds and insurance companies hold 29% of all government bonds. In Canada, 27.6%. In Japan, over 15%. The liability-driven investing strategy that dominates pension management directly relies on the ability to buy government bonds with duration matching the payout profile. Insurance companies face even stricter constraints through Solvency II regulation in Europe and similar regimes in other jurisdictions. Under these rules, insurers must maintain capital at a level equal to or exceeding the solvency capital requirement capital needed to absorb losses with 99.5% probability over 1 year. When calculating this capital, government bonds with AAA divided by AAA, ratings receive zero spread risk weighting, meaning insurers can hold them without any additional capital requirements. Corporate bonds, even of the highest rating, require capital reserves. Additionally, best estimate liabilities, the valuation of insurance obligations, is calculated using the risk-free rate determined from the government bond yield curve. Research on German insurers showed that 25% of companies could not meet Solvency II requirements without the ability to hold government bonds. Annuity products, where insurance companies guarantee fixed payments decades ahead, become economically unviable without the ability to invest insurance premiums in long-term government bonds with matching duration. Banks are bound by even more direct regulatory requirements through Basel III. The liquidity coverage ratio rules require banks to hold enough high-quality liquid assets to survive a 30-day stress deposit outflow scenario. The formula is simple. LCR equals stock of high-quality liquid assets divided by net cash outflows is greater than or equal to 100%. Government bonds are classified as level 1 assets, with zero haircut. Banks can count their full nominal value for LCR. Moreover, domestic government bonds can constitute 100% of the liquidity buffer regardless of the country's credit rating. Highest rated corporate bonds, AA or above,
are classified as level 2A with a 15% haircut, and bonds rated A to BBB as level 2B with a 50% haircut, and their share is limited to maximum 40% and 15% respectively.
Practically, this means large US banks held up to 26.3% of their assets in government securities at the peak February 2022. And European banks hold significant shares of domestic sovereign debt. If governments stop issuing bonds, these institutions face a 3-level crisis. Regulatory level, banks violate LCR requirements. Insurers cannot meet Solvency II. Pension funds breach prudent person investment mandates. Operational level, impossible to hedge long-term liabilities safely. Absence of collateral for repo operations. Loss of liquidity management capability. Systemic level, all institutions simultaneously forced to seek alternatives, creating massive demand for limited supply of corporate bonds and other safe assets, driving their prices to irrational levels and depressing yields so they cease to be attractive. Research shows that a 10 percentage point increase in non-resident holdings of government bonds reduces yields by 25 to 43 basis points. The reverse effect means disappearance of these bonds would cause dramatic increases in borrowing costs across the economy. Central bank monetary policy fundamentally depends on the existence of a liquid government bond market. When the Federal Reserve or European Central Bank wants to lower interest rates to stimulate the economy, they buy government bonds. The mechanism works like this. The central bank electronically creates reserves in the selling commercial bank's account, crediting them with the purchase amount. This money doesn't come from anywhere, it literally appears out of thin air as an accounting entry. The total amount of bank reserves in the system increases, meaning banks have more money to lend. Simultaneously, massive bond purchases by the central bank increase demand for them, bond prices rise, and yields, which move opposite to price, fall. Falling government bond yields translate into lower borrowing costs across the economy. Mortgage rates become cheaper, corporations can borrow more cheaply, consumer loans become less expensive. This is the classic open market operations mechanism, used daily to fine-tune the money supply. Selling government bonds works in reverse. The central bank debits reserves from purchasing banks' accounts, reducing the total amount of money in the system. Increased bond supply lowers their prices and raises yields, which increases interest rates across the economy. More expensive credit reduces spending and investment, cooling the economy and restraining inflation. Why government bonds specifically? Because they have minimal credit risk, backed by the full faith and credit of government, high liquidity, easy to trade in large volumes, are standardized homogeneous securities, have deep markets, many buyers and sellers, and the central bank acts as a trusted neutral party. If central banks started buying corporate bonds, it would create accusations of favoritism. Why are some companies chosen and not others? Additionally, corporate bonds carry credit risk, complicating valuation and management of the central bank's balance sheet. During extraordinary crises, central banks move to quantitative easing, QE, a large-scale version of open market operations. After the 2008 financial crisis,
the Federal Reserve bought $1.75 trillion in the first wave of QE, including Treasury securities and mortgage bonds.
These weren't daily minor adjustments, these were pre-announced programs with specific targets months ahead. The transmission mechanism works through the portfolio balance channel. Investors who sell bonds to the central bank seek alternative investments with higher yields. They buy corporate bonds, stocks, real estate.
University of Chicago research showed that for every $100 billion purchased by the Fed, corporate bond yields fell by 8 basis points and funds reinvested over 60% of proceeds into corporate debt. During the COVID-19 pandemic, the Fed bought over $4.5 trillion in 2 years, a scale impossible without the gigantic government bond market.
History shows what happens when government bonds become scarce. Australia in the early 2000s achieved near zero net debt thanks to the Howard government's budget surpluses.
By 2006 to 2007, the country had negative net debt. The government was a net creditor. But this created serious problems. Government bond trading volume fell 30% from $389 billion, 2002 to 2003, to $273 billion, 2007-08.
The Reserve Bank of Australia was forced to urgently expand the list of eligible securities for its operations. In June 1997, they added state and territory bonds. In 2000 to 01, AAA-rated international organisation papers, increased use of foreign exchange swaps. The RBA governor acknowledged in May 2002, if we ever reach the point where there was insufficient Commonwealth or state debt, we would likely find a way to conduct market operations using private instruments. But this would be a dramatically inferior option. Ultimately, the Australian government decided to continue issuing bonds even without fiscal need, simply to maintain market infrastructure functioning and provide monetary policy with tools. As long as the world exists in its current form, no alternative can completely replace government bonds. Covered bonds, issued by banks against pools of mortgages, have higher yields and double protection claims against both issuer and collateral pool.
The European covered bond market totals 2.6 trillion euros, which seems large but is less than a third the size of the US Treasury market alone.
More critically, covered bonds carry credit risk during the 2008 crisis. Even highest rated papers lost liquidity and spreads widened dramatically. Under Basel III rules,
they are classified as Level 2A assets with a 15% haircut for LCR, meaning banks can count them only at 85% of nominal value, and their share is limited to 40% of the liquidity buffer.
Under Solvency II, they don't receive zero risk weighting, so insurers must hold additional capital against them. Supranational organisation bonds from the World Bank, European Investment Bank, Asian Development Bank typically have AAA ratings and are recognised as Level 1 assets under Basel III.
The European Union issued 712 billion euros under the Next Generation EU programme, creating a new pool of European safe assets alongside German Bunds.
But fundamental problems arise. First, political uncertainty. The EU's bond issuance mandate expires in 2026, and it's unclear whether it will be extended, as questions about the Union's taxing authority remain unresolved. Second, Secondary markets for these bonds are less liquid. They lack the liquidity support mechanisms of sovereign bonds and aren't covered by the ECB's transmission protection instrument.
Third, scale. Even if all supranational institutions maximally increased issuance, the total size would remain a small fraction of the $80 trillion global government bond market.
High-grade corporate bonds offer higher yields, but the 2008-09 crisis events definitively proved that even AAA ratings on private papers don't guarantee safety during systemic shocks. Investment-grade corporate bond spreads widened by over 400 basis points at the crisis peak, and many structured product markets considered safe as treasuries froze completely.
The private securitization market fell from $3 trillion, 2007, to $750 billion, 2010. Additionally, corporate bonds correlate strongly with equities during stress, precisely when investors need negative correlation for portfolio protection. Gold is returning to fashion. Central banks increased gold's share to about 15% of reserves in 2025, and the price rose 42% to $3,300 per ounce.
But gold generates no interest, income, is expensive to store, inconvenient for settlements, and has limited supply, making it impossible to use as the primary monetary policy mechanism. The Atlantic Council in 2025 summarized the problem clearly: there simply aren't enough safe assets for investors to walk away from treasury bonds. German bonds are less than a tenth the size of the US Treasury market. British gilts experienced a confidence crisis in 2022. Japanese JGBs are subject to massive central bank intervention. Chinese bonds lack the transparency, liquidity, and rule of law necessary for global safe asset status. ECB President Christine Lagarde acknowledged that Euro bonds can complement but not replace US Treasury bonds. The fundamental problem is that safety derives from sovereign backing the government's ability to tax a productive economy and print currency as a last resort. Private alternatives by definition lack this property, regardless of how quality the underlying assets or structures. The real problem is that the world already experiences a safe asset shortage. Economists Ricardo Caballero, Emmanuel Fahy, and Pierre-Olivier Gourinchas, in their influential 2017 study, showed that the supply of safe assets has not kept pace with global demand since the 1980 seconds. The reason is simple. The aggregate growth rate of advanced economies producing safe assets has been lower than the world growth rate driven by rapidly developing high savings economies like China. The signature of this shortage is the persistent decline in global safe interest rate. The world supply of safe assets collapsed from 37% of world GDP in 2000 and 7 to 18% in 2011 after private safe assets vanished in the crisis and European sovereigns lost high ratings. The safe asset shortage can force economies into a safety trap, a form of liquidity trap, where output becomes the adjusting variable through the impossibility of satisfying demand for safe savings. History provides us with one clear natural experiment of what happens when a country completely liquidates government debt. On the 1st of January 1835, President Andrew Jackson achieved his primary political goal. The United States became a country with zero national debt, the only time in US history. Jackson viewed debt as a moral failing and national curse, reflecting his personal traumatic experience with debt obligations in Tennessee that nearly ruined him.
Over 6 years, he aggressively reduced federal debt from $58 million.
Using revenue from massive federal land sales in the West, 63 million acres territory the size of Oklahoma, sold between 1834 and 1836, fueling a crazy real estate bubble and vetoing spending bills, including national transportation programs. He also destroyed the Second Bank of the United States, which he considered corrupt. What happened next? Historian John Steele Gordon described as an enormous crash and the beginning of the longest depression in American history. The government found itself with a surplus but no debt to invest it in, and no national bank to hold it. The surplus was distributed among state banks, which historians say went wild, began printing huge amounts of money. Land speculation spiraled out of control. In 1836, Jackson issued the Specie Circular, requiring all public land purchases be made in gold or silver, causing a sharp liquidity squeeze. A year later, in 1837, the Panic of 1837 began. The economic depression lasted 6 years before growth began to recover. The government immediately resumed borrowing, and national debt has existed continuously since then. It's important to understand, no economist claims that debt repayment directly caused the depression. The causes of the panic of 1837 are numerous and complex British credit crisis, cotton overproduction, bank failures, but debt liquidation removed a critical stabilization tool precisely when it was needed. Historian Ann Daly from Mississippi State University explains, "Without debt, there are no more government bonds. Government bonds are a very safe place for investors to hold their money. When the bubble burst, there was no safe haven, no instrument for fiscal stimulus, no mechanism for absorbing excess liquidity." Economist Neil Buchanan from George Washington University notes that the country eventually had enough sense to borrow again. Modern Australia provides an example of how smart governments think. When budget surpluses in the early 2000s allowed the country to approach zero debt, the government conducted a comprehensive review of the future of the Commonwealth government securities market. The conclusion was clear. Even in the absence of fiscal need, bond issuance should continue to maintain market functioning and provide monetary policy with tools. The benefits of maintaining a liquid government bond market outweighed the cost of maintaining small debt. This decision proved prescient, as during the 2008-09 global financial crisis, Australia had fiscal space and a functioning bond market for crisis measures. Leading economists have reached consensus on this issue. Paul Krugman emphasizes that given political will, debt problems can be easily solved. To the extent debt is a problem, it reflects political dysfunction. Lawrence Summers, in his secular stagnation theory, argues that advanced economies face chronic excess of savings over investment, making fiscal expansion and government investment necessary and sustainable at zero real interest rates. The Brookings Institution summarizes the mainstream position. As Alexander Hamilton explained, debt can be a blessing. It can facilitate commerce, fund national defense, fight recessions, finance investment, and provide liquid and safe assets to investors. Even Kenneth Rogoff, known for his skepticism about high debt, acknowledges that different countries have different debt tolerance. Some advanced economies can sustainably maintain debt to GDP ratios over 100%, while some emerging markets experience stress at just 15-20%. The optimal level of government debt is not zero, but a positive and sustainable amount that grows with the economy while maintaining a stable or declining ratio to GDP.
The foundational 1998 study by S. Rao Ayegari and Ellen McGrattan found optimal debt at approximately 67% of GDP for the US, close to actual post-war levels.
Modern IMF research has shown that no magic threshold exists above which growth is dramatically impaired. Debt trajectory matters more than absolute level. Countries with high but declining debt grow just as fast as countries with lower debt. The key is maintaining debt on a trajectory where interest rates don't exceed economic growth rates, making debt self-servicing. When governments attempt to completely repay debt, they dismantle important infrastructure, create shortages of assets the financial system still needs, deprive central banks of tools to stabilize the economy, and remove fiscal space for crisis response. The paradox is that attempting to achieve zero debt for moral reasons creates greater economic instability, higher long-term costs, and elevated systemic risk. An economy is not a household where debt is a burden to minimize. It's a complex system where moderate government debt performs numerous vital functions that no alternative can fully replicate. The real task is not to liquidate debt, but to manage it wisely. Investing borrowed funds in productive projects that generate sufficient returns to cover servicing costs, and maintaining a sustainable trajectory that allows response to unforeseen shocks. In a world where financial stability depends on the existence of reliable, safe assets, complete government debt repayment would be not a triumph, but a catastrophe.